Hello. Hi. Greetings. First of all, wish you all Happy New Year 2018. I'm just starting this session with the queries which you have raised in uh, WhatsApp group between the training session between 5 p.m. to 7 p.m. and weekend 10 a.m. to 12 p.m. So thanks for joining this session. Hope the queries answered might be useful to you. Appreciate to share your feedback. Um, Let me take you through the questions which we shared previously to your WhatsApp group. There are about 19 questions which we are going to take forward in the next 15-20 minutes. I'll help you to understand in most short way as possible. So, what's triangular and rectangular pattern breakout? What are the other breakouts patterns? How to identify? Now, there are a lot of patterns available in technical analysis, but as quoted, triangular and rectangular quoted specific. So I am explaining the same. There are three types of triangle patterns in the triangular module. The one is symmetrical triangle, which as quoted looks like this, and one is descending triangle, and one is ascending triangle. The difference is symmetric triangles from high to low, top from low to high, bottom. It's called symmetrical. And anytime the price moves out of this triangle, only then you have to initiate trade. When it breaks up, it's called upside breakout. When it's break downward, then it's called a downward breakout. So anytime if price is inside this pattern, probably you should avoid trading, or you should avoid taking any long positions or a short positions. So the same apply in the descending triangle, where you can see the straight line and you see price touching the highs and again coming low, then probably the price will be sloping like this downward, right? From top it is downward, and the bottom it looks straight. So every time it comes in this uh, place and it gets supported. So this is called a descending triangle. And the ascending triangle, normally it's from bottom to high, and the highs are always equal, and it is called a ascending triangle. So breakouts always refers to this arrow mark which is mentioned here. It is upside. When it is an upside, it is an upside breakout. When it is down, it is downward breakout. So rectangular breakout is nothing but a box trading. Normally they used to say box trading. The price always slope inside this box trading. When there is a high, the low will be here. When there is a high here, the low will be here. As same, it keeps moving up. So whenever the price is inside the box, you should avoid trading. When it's break out or breaks down, then probably you can initiate your trade. Hope it is clear. Let me take you to the next question, why there is a difference between the previous day closing price and the next day opening price of a stock, though the market is closed for that interval. It's really a very good question, but before that, before I answer your exclusive question, let me give you a snapshot on the timing first. There are three time slot pre-opening session. The normal market hour is 9:15 a.m. right? So before 9:15 a.m., what happens in the market? Okay, this normally happens in the terminal. 9 a.m. to 9:08 a.m. This is the order entry session where you can place an order to buy and sell stocks in this duration. One can also modify or cancel his orders during this period. After 9:08 a.m. to 9:12 a.m., this session is used for order matching. That is, the order which you have placed in 9 a.m. to 9 a.m., the order will get matched and calculating the open price of a normal session. You cannot modify or cancel after 9:08 a.m. 9:08 a.m. to 9:12 p.m. It only matches and it calculate the opening price of a normal session. When 9:15 market opens, it all has to get matched, and that happens between 9:08 a.m. to 9:12 a.m. So 9:12 a.m. to 9:15 is a session used as a buffer period to understand the calculation between 9:08 a.m. 9:08 a.m. to 9:12 a.m. So this is the timing pre-opening session and post-closing session is an important aspect where 3:30 market closed, but 3:40 to 4 p.m. you can still place buy or sell orders with the closing price, not as the price you wish, but for assuming market closed at 100 rupees, particular stock, A market closed at 100 rupees. You can place order at 100 rupees or 99.5 or 100 and 100.50 or 60. Only this difference, provided there is a buyers and seller. If so, then your order get confirmed, but it will not get executed. It get confirmed and it gets executed in the morning session after normal hours. And that is the reason when you see there are some certain transaction happens between 3:40 to 4 p.m. and that get adjusted in the morning 9 a.m. to 9 p.m. 9 a.m. Sorry. So that is where the trade difference comes in. Hope it is clear. Now, next question, what are the parameters that indicates whether the stock is fundamentally sound or technically? So before you get into more in depth of fundamentally or technically, it's like an ocean to understand. But important factors which you can as a basic discipline and basic to follow is that any company when you look at, you should look at not an immediate cash profit or sales growth, but it should be a consistent cash flow. The company should have a consistent profit, consistent sales growth, and the management experiences. Along with, if you're looking at something for a longer tenure, then you should look at a portfolio analysis. Portfolio analysis is something where if you can surf in the Google, you'll probably find what are they. So it's kind of a very good analysis. Normally, it is done by analyst to understand to determine the company's structure and the corporate strategies, right? So, and the technical part, you should look at main on the chart with volume breakouts. So any charts breakouts, there is breakouts on upper side or on the downward side, then probably it should support with the volumes one. And any stock with an oversold range to bet on buy, provided with sound fundamental knowledge. Why it with sound fundamental knowledge is any stock with oversold range does not mean that it's going to have a very good long move. Provided example, if you can look into Satyam. When it started correcting, it has reached to the oversold range. But if you feel I can buy now, you cannot buy that because fundamentals were weak. If you would have bought at any of the correction period, you would have got stuck. Okay? That's a small example, and after that, the stock has moved up. That is a different story. But when the correction is happening, you should understand why the correction is happening. So, right? So, this is hope I have answered your query. But fundamental and technical is a vast subject where you cannot understand with these two basic principles. But basics to follow is you can follow this one. So about an intrinsic value, see, it is again an high level question where normal the value investor used to focus more on this. So for which you to calculate an intrinsic value, you should be aware of all accounting principles, or you should know how to value the company first. So valuing companies are of different kinds. One of which is called the discounted cash flow (DCF). So free cash flow of a company, if you can look at the intrinsic value, is nothing but a net present value of all your futures cash flow, right? So it determines your present value of your company or a share price value of your company, right? Now, the objective, if you can look into in a static way to give you an example is, assuming that you bought a stock price value of 10 rupees, but when you calculate the intrinsic value of a stock is say about 7 rupees. So now the difference of 3 rupees you predict as if the stock has a potential to reach 10 rupees soon, and that is your profit, 30% profit. So I'll enter now. Now, it does not mean all the time the intrinsic value low stock will always reach to its actual price. It is not mandatory, or it is also not mandatory that intrinsic price are higher than the stock price is not a good stock. No, absolutely not. There are various fundamentals, ratios where you'll have to look into. But to give you snapshot understanding, this is what the intrinsic value is. So if the current stock price much lower than the intrinsic value per share value calculated, then you might consider investing, right? So this is a formula you can look into where if you wanted to really look into how to derive the value, so take a free cash flow for year X and multiply the expected growth rate. Then calculate the NPV of this cash flows by dividing it by discounted rate. Project the cash flow 10 years into the future and repeat step 1 and 2 for all these years. At least to give you a good intrinsic value, you should analyze for at least 10 to 12 years. Add up all the NPAs of the free cash flow, multiply the 10th year with 12 to get the sell-off value. Add up the value for step 4, 5, cash equals to arrive at intrinsic value of the entire company. And simply divide this number with the number of shares outstanding to arrive at the intrinsic value per share. So if you are really interested, I would appreciate to follow this 7 rule formula to will get your intrinsic value. Right. So next question is how to identify the support and resistance in the stocks. So resistance is something where if you can look here, each time stock reaches this high and started sloping down. So this is considered as a resistance line. Now if you can look into the bottom, every time stock reaches this place bottom and bounces back, then it becomes a support line. So this is called a support, this is called a resistance. Okay, right. So this is next we'll get into how can we trade in futures and don't it more risky than cash. Of course, yes. To trade in futures market, you need a sound technical analysis knowledge, proper discipline, controlling of emotions is important. High risk, high return strategies important to revise frequent trading stop losses in trading. So, if you do not have a technical knowledge and you are just following your friend or relative who's not experienced in the market or is not aware, then probably you're uh, placing your capital on risk. So, when you say gambling, then the gambling takes place here. Actually, the stock market is not a gambling, it's a business. So if you look at the company's principle and investing those in the right way, then probably it's a business. When you, without knowledge, investing in the market, tending towards losses, then it becomes a gambling. So its choice is yours how you wanted to take this business forward, right? Hope this helps you. Is there any stop loss process in sell or equal to that? There is no rule or a thumb rule which I could say that you need to follow, but thing which normally can be followed in a disciplined approach as it is given below. Example given as a Nifty. If you're trading in Nifty one lot, risk should be 3% and profit target to be 7 to 8%. Assuming margin 65,000 rupees per lot, then your risk 3% remains 1,950, 30 points. Profit 7% rupees 4,550, 60 points target. So this is how this is the way you can place your trade in the futures market. Now, what is put and call? So normally the beginners get confused with the put and call. So give them a simplest way of understanding. There's 3 important points you have to understand is both are option contract has a validity of 1 month. If you have a less capital, use option contracts such as put and call. Example, to buy a Nifty one lot in future cost you about 65,000 rupees. Now when you say I have only 15,000 rupees, then probably you can try the put and call, right? So normally it is called PE or CE by brokers or money managers, right? The brokers and money managers normally put or call, they used to say buy PE, buy CE. So this is kind of a word you will be able to hear from them. So there are 3 way in which broker also term this as buy call, buy put. Okay, so when to buy call, when to buy put. That is what I have mentioned here. When you predict market is going up, then you buy call. When you predict market is going to fall, then buy put. Okay, both are buy. Now when you sell both, then it becomes writing the contracts, right? When you sell both, it becomes writing the contract. When you buy one and sell one, then it becomes straddle techniques or hedging the contracts. Simple, right? Let's go about next question. What are the significance of month end expiry last Thursday of the month? What will happen if we don't honor expiry date? It's simple. Automatically cash settled on the day of contract expiry. So if you don't settle on the expiry date, automatically contracts get expired and get settled with the profit. If you have, it's get into credited to your account. If it is loss, you have to pay a margin to your account, right? Next question, how much percentage to be allotted for the futures trading? There is no such rule. However, to trade under safe zone, always follow 80:20 ratio, assuming 80 as a cash delivery, 20 as futures trading. If you have 1 lakh rupees, you should allot only 20,000 rupees for futures trading, right? Then, how can we invest in USA securities from India? As of now, ICICI Direct platform offers you to invest in overseas market. You have to open account with ICICI Direct and Saxo Bank. One has a limit of investing up to 1.5 crores in a financial year. As of now in India, I foresee only ICICI is helping Indian citizens to invest in the uh, other emerging countries stocks. So if you wanted to take a privilege, you can contact them. And in case of fundamentals, what role PE ratio has got to decide about buying a share? So many of them have a confusions, in terms of they either look forward the intrinsic value, or they look at the PE ratio, or they look at the EPS. See, there are about 18 to 25 ratios which you need to compare before entering a stock. Only with the one ratio you cannot decide the company whether it is good or a bad. But since the question is raised on the PE ratio, I'll take you through it. Lower PE ratio means that the investor are paying less per rupee of company's earning, and that it will take less time for company to earn enough to buy back its share. So while there is no hard and fast rule that answers the questions in general, many value investors consider that the lower is better. If you're looking at two stocks that seems otherwise comparable and are in same industry, the one with a lower PE ratio could be better bet if your goal is to buy undervalued stock. So what do you understand by this? So it is similar to your intrinsic value. Okay, uh, to understand the undervalued stock. When you say undervalued stock, to undervalue and overvalue stock, there are a lot of parameters that you have to look at. Not only a PE ratio can give you the tool saying that it is an undervalued stock, but it requires a lot of inputs to be shared. But as of now, I think it's enough that I personally sense that normally how to interpret is important. That same like when the one with a lower PE ratio, always good better bet if your goal is to buy undervalued stock. Okay, so P ratio isn't the only number to consider when you're deciding whether to buy shares. You can look at earning charts, sales figure, and other fundamentals of a company before taking the investment decisions. Right? Okay. What ratios are factors we need to look to identify whether the share is undervalued or at a par or at overvalued? Again, the question comes within P ratio, I believe. Right? So again, it's a high level question. You need accounting knowledge to calculate certain ratios. However, we'll make it simple for basic idea. Always look for PE ratio and then compare it to the industry average. Now, you have when you're picking up the Infosys stock, okay, then the industry average for IT there will be a PE ratio. You have to compare with that versus this and see which is a lower. If it is lower than your industry industry value, then probably it is a good bet. A higher PE ratio indicates that you are paying more for the stock to earn that a particular EPS. Hope it is clear. So if you find that PE ratio of a company is less than the industry average, okay, then you can be assured that the stock is undervalued and is likely that it is also fundamentally strong considering other factors. That reverse means that the stock is overvalued, which means if your industry average is 10 and your PE ratio of a stock is 7, then probably that's a good bet to interpret. If industry PE ratio is 10 and your stock PE ratio is 12, then you are paying higher cost than your industry average, which is called overvalued, right? Okay, then we'll get into the next question. What are the overbought stocks and indicators for that? Overbought stock, nothing but highly upward moving stocks or extended price move to the upward. Any stock which is consistently moving up, then at one step it is called as a overbought stock, which means that's the time the trend reversal will start in that particular stock. And to identify those stocks, you need an indicator called RSI, MFI, money flow index, uh, stochastic indicator, and MACD. Normally, these are the leading and lagging indicators where we can predict you the next upcoming trend in the market. Okay. Is there any website or a place which help in tracking changes in regulation in various industries, which can help us in determining which industry to focus? You need to focus on government website, mostly RBI site, which has a lot of data which you need to spend time, and keep tracking the newspaper and business magazines. No other site. Surfing the newspapers only for the news purpose, it's helpful. Do not track the stock recommendation into that. Let's go into how to check the book value of a stock. The term book value is a company's assets minus its liability. Is sometimes referred to as in the balance sheet of the companies. If you can look into stakeholders equity, owners equity, shareholders equity, or simply equity, are all referred as book value. Okay. Now, if you can find this in many finance application today, you need not require to calculate. You can find in money control or any other application. The moment you type stock name, it gives you a complete market cap and its dividend yield, the book value, face value, is all been given. You need not require to calculate, but still, if you need to calculate, the formula is given below, right? Okay, there are many tempting calls issued by brokers, but to verify the veracity of claim is difficult. In those situations, what should we do? We fall in trap. How much percent of savings should invest in stock? It's again controlling of your emotion. Do not get carried away with such calls. So we often used to share this in the group. Do not get carried away with those calls. It's all making a manipulation in the stock prices. So answer to your query is how much percentage of savings should invest in stock? Considering your lifespan of 100. See now, assuming our life validity, I would say, is an age 100, considering as 100. Minus that from your current age. So that gives you a percentage of investment in the stocks. Assuming I have rupees 1 lakh, my age is 45. 100 minus 45 is equal to 55 percentage of 1 lakh. That is 55,000 rupees should invest in stocks, balance as liquid or fixed income products. So normally people used to do 1 lakh, I'll invest 1 lakh into the equity market. No, you should not do that. If you do that, you are taking a high risk on your capital. Okay, right. Does stock is the only way to beat inflation in long term? Definitely yes. If you have a corpus of 100 and inflation is 6%, now if you can look into the below example, if you have earned 100 rupees and you're not investing it, okay, then just rupees 94, that becomes just rupees 94 after a year if it is not invested. You're just having idle money. You're not investing anywhere. It becomes an idle money. Though you're investing, still it becomes a negative return. For example, you're investing in an FD. FD current rate is 6.5% per annum interest rate, and inflation is 6%. Assuming invested 1 lakh rupees in FD, then you have earned negative returns of more than 0.74%, inclusive of 30% tax calculation. Sorry, I missed out minus 0.74%. That is, if you can look into FD returns, is 6.5%, and 6% is an inflation. So which means if I deduct a tax 30% in 6.5%, it should be say about 5.2, 5.5%. So if you can look into that minus the 6%, then it comes minus 0.74% inclusive of 30% tax. So the average equity market statistics has proven and delivered more than 13%, and none other investment in today's current scenario has such potential to deliver the same. So equity market is the only option which can yield you better returns. For an instance, you can look into this chart. Post-tax returns, CAGR of an asset class, equity is 5 years 11%, 10 years 17%, 15 years 13%, 20 years 12.5%. Rest of all, if you can look into, all below 10%. So this is the answer for your query. Then let's go for the next question. A company giving handsome dividend, I think it is dividend, is good for a long term. It's not divided, it's dividend. Okay. The company giving handsome dividend is good for long term. Dividends are often offered by established companies, but dividends may also be used by a new or in trouble companies attempting to attract the investors. Now, uh, now I'll tell you an example, right? You go to a car showroom and he says the car value is say about 10 lakhs. I'm offering you a discount today, this month is about 50,000 rupees. So you might be tempted to buy. But the same 10 lakhs car, if the dealer offers you with 3 lakhs rupees discount, what will you think? That is called a value trap, right? Also known as dividend trap, occurs when investors are lured in by high dividend yield, only to find the underlying company was not such a great buy after all. Some deals are too good to be true, but not all the time. A sharp price movement will dramatically affect the stock dividend yield, since yield moves inversely to the price. So when there is a high dividend, please recheck the company why they are paying you such high dividends. Recheck with the fundamentals, then probably take a call. But any dividend paying companies will not have a good price appreciation over a period of time. So dividend is something a tax free, so many people take an advantage of it, but only your capital comes back to you with the tax free returns. Right? Thank you. This was the session today. I think you might have got something good to understand, and I believe I was helpful in giving you right inputs. Please do share your feedbacks. Thank you very much.